For decades, if a company wanted to hit the stock market, there was really only one way to do it: the good old IPO, the initial public offering. But over the last few years, something's been changing. Some of the biggest names in tech have started pioneering a totally different path, one that really challenges the way Wall Street has done business for a very long time.
So, I want to start with a number: $125 billion. That's a huge figure, right? Well, according to some deep research, that's roughly how much money companies might have left on the table over the past 50 years when they've gone public.
And that number, well, it brings up a massive question. What if the traditional way of going public is actually kind of flawed, costing founders and their early investors billions and billions of dollars? It's that exact problem that has sparked a pretty incredible innovation in finance. So how did we get here, and what's the alternative? Let's dive in.
Okay, so here's our game plan. First, we're going to dig into the IPO's billion-dollar problem. Then we'll look at the solution that's emerged, the direct listing, and exactly how it works. After that, we'll get into the risks and some really important new rules. And finally, we'll ask the big question: what does this all mean for the future of going public?
All right, first up, to really get why this new way of doing things is so important, we have to understand the old way. For nearly a century, the IPO has been the undisputed king of the public markets. But, as we're about to see, it comes with some pretty serious costs.
So the traditional IPO is really all about one thing: raising fresh cash. A private company hires these powerful investment banks to act as what they call underwriters, and their job is to help create and then sell brand new shares to the public, bringing in a ton of money to fund the company's growth.
But here's the catch. It's something called the underpricing phenomenon. This chart basically shows the average pop or jump in price on the stock's very first day of trading. Now, that big jump is awesome for the new investors who got in early, but think about what it means for the company. It means they sold their shares too cheaply. They left a massive amount of money on the table, those billions we just talked about.
And get this, that's just the indirect cost. On top of that, there's the direct fee. Companies will typically pay their underwriters a commission of up to 7% of all the money they raise. If you're talking about a multi-billion-dollar IPO, that is a huge, huge check to write.
So all this frustration with the high costs led some really innovative companies to ask a simple question: what if we could just bypass the whole system? And that question led to the rise of the direct listing, a radically different way to get onto the public market.
Okay, so in a direct listing, a company doesn't create or sell any new shares. Instead, it simply allows its existing shares, the ones held by employees, founders, early investors, to be sold directly on a stock exchange. The goal here isn't to raise new money for the company. It's about providing a way for the insiders to finally cash out. It's about liquidity. Let's put these two side by side, because this is where it gets really clear. An IPO uses underwriters to sell new shares to raise capital. That comes with high fees and usually a 180-day lockup period where insiders are forbidden from selling. A direct listing, on the other hand, uses financial advisors for a lower fee, sells existing shares for liquidity, and has no lockup period at all. The big takeaway here is the shift from a company-focused capital raise to an investor-focused liquidity event. Now, this wasn't just some theory cooked up in a business school. In 2018, the music streaming giant Spotify became the first major company to actually go public this way, and they proved it could be done on a massive scale. So how did they and others pull this off? Let's get into the mechanics. So how does a company actually do this? A direct listing gets to skip that whole traditional IPO roadshow, but don't get me wrong, it is still a highly regulated process with several really key steps. First up, just like an IPO, the company has to file a super detailed S-1 registration form with the SEC. No cutting corners there. Then, instead of a grueling 2-week roadshow, they usually host a single investor day, which is basically a webcast to tell their story to potential investors. After that, the exchange sets a non-binding reference price, and then, on opening day, the market just takes over. The actual stock price is set purely by supply and demand. Now, you got to understand, this approach isn't for everyone. It really works best for companies that are already well-known, household names with really strong brand recognition. Why? Because they don't need underwriters to go out and generate buzz. The public already knows who they are. That's exactly why Spotify was a perfect candidate. Just look at this chart. Their subscriber base was already massive and growing like crazy before they ever hit the public market. Of course, anytime you're blazing a new trail, there are going to be risks. The direct listing avoids some of the old problems, sure, but it definitely introduces some new ones. And what's really interesting is that recently, the entire landscape has been reshaped by the courts.
The pros are pretty clear, right? You avoid the underpricing problem and those high fees,
Insiders get to sell their shares right away, and you're not diluting ownership. But the cons, they're significant. Without underwriters there to help stabilize the price, you can see way more volatility, especially in those first few days of trading. The opening price is completely at the mercy of market demand on day one, and that's a huge unknown.
But one of the biggest risks for companies has always been legal liability, getting sued. And a recent Supreme Court decision has dramatically changed that whole calculation, actually making direct listings look a lot more attractive.
So this Supreme Court decision in the Slack case is a really big deal. In a nutshell, the ruling makes it much harder for investors to sue a company after a direct listing. An investor now has to prove they bought the exact shares that were covered by the initial registration filing, which is, well, it's almost impossible to do when there are all these other previously unregistered shares trading freely at the same time. This is a game changer because it significantly lowers the legal risk for companies choosing this path.
So where does all of this leave us? We've seen the problem, we've seen the solution, and we've seen how the risks are evolving. The final question is, is the direct listing just a niche alternative for a few tech giants? Or are we watching the beginning of a permanent shift in how companies join the public markets?
I mean, the evolution here has been incredibly fast. What Spotify kicked off in 2018, other big names like Slack quickly followed. And now, the stock exchanges themselves have even changed their rules to allow companies to raise new capital through a direct listing, kind of blending it with a traditional IPO. It has absolutely cemented its place as a viable and powerful alternative. It's fundamentally changed the math for any big private company thinking about its next move.
This all leaves us with a pretty provocative final thought. As more of these well-funded private companies weigh their options, are we witnessing a fundamental change in purpose? Is it possible that going public in the future will be less about raising cash for the company and more about creating a fair and efficient market for the people who built it? The answer to that could reshape Wall Street for decades to come. This is not financial advice.